Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week I'm speaking with Rob Thummel, who's Managing Director and Senior Portfolio Manager at Tortoise. Rob, great to have you on the show.
Hey, thanks for having me.
So I really want to get your take on the energy markets right now, Rob. A week or so ago, we saw oil prices plunge really to the lowest level since 2021, the pandemic, on the back of this trade war stuff that's going on, Trump's tariffs. Do you think that move was an overreaction?
Well, we think, so when you look at oil prices, obviously all about supply and demand. And if you look at oil prices, the concerns about the tariff war creating, this global economic slowdown, reducing oil demand really is on the demand side, and it's created a lot of uncertainty there. The flip side is the supply side. Then what happened then? Well, as you know, OPEC Plus came out and said we're going to increase the supply of oil as well. So we've got a lot of uncertainty in the oil markets and the global economy, and that's created this lower oil price. Is it overdone? You know what? I think really where oil prices need to trade in the U.S. is somewhere above $60. $60 to $70 is a good price range. If we see oil prices get below 60, you're going to see U.S. oil producers start to reduce production. And so right now we're in a pretty good spot, $63 or so as we record this today. We'll see where it ends when this comes out. But anyway, long story. The short story is oil prices are at a good spot actually for consumers because gasoline prices are lower, and that will boost demand going forward. And so I wouldn't necessarily say it's an overreaction by any means. I think it's a good reflection of really where supply and demand are at the present time and the uncertainties associated with both.
Rob, you have two energy-focused ETFs on the market, and they're not like a lot of the other energy ETFs that are out there because when people think invest in energy, they want oil prices to be high. These are infrastructure funds, so that's not necessarily the case. Can you tell us a little bit about these two ETFs?
Yeah, so first of all, both of these ETFs really focus a little less on oil and more on what we think is the future of energy and and the energy sector is being redefined, and that's natural gas. So specifically, our Tortoise Essential Energy Fund (TPZ). It's a new active ETF. It's really focused on an electrification theme. If you think about going forward, what's the energy sector going to be, and what's going to define the sector? Well, AI is going to play an important role. Artificial intelligence is going to play an important role in the global economy, basically in the U.S. economy as well as manufacturing and advanced manufacturing. What do both of those need? They need more electricity. So we're entering in the age of electricity in the U.S. And what our fund is focused on is the opportunity that increased electrification and increased electricity demand, and how you benefit from that. We think you benefit in two ways in our TPZ fund. Number one, obviously electricity demand goes up. You need more electric generation. So we're focused on the companies that are generating that new electricity in the U.S. In addition to that, we're focused on where's the fuel source going to be to generate the electricity. That's where natural gas comes into play. So we focus on natural gas pipelines, and those companies that are providing the natural gas that basically generates that generates the fuel to generate the electricity demand going forward. And so that's really our focus in TPZ. TPYP, little different, but maybe just nuanced a little bit. It focuses more on just broader energy infrastructure, as you highlighted. It's a passive ETF, and so it focuses on just the energy infrastructure. So it's natural gas pipelines, refined products, gasoline pipelines, oil pipelines. So it has a little bit more of oil exposure, as you highlighted, than TPZ, but it focuses just more on the pipeline infrastructure. The reason why all that's important is because if you're concerned about commodity prices, the infrastructure companies don't necessarily take commodity price risk. They only take volume. They take mostly volume risk, not commodity price exposure. So they're a little bit different and less exposed to the ups and downs of commodity prices, more exposed just to the overall global economy and the U.S. economy as well.
So two really interesting funds there, TPZ and TPYP. Can you just in a nutshell explain the thesis behind the two? If someone's trying to decide which one to buy, which one's right for them, is one more of a yield play than the other? Is one more of a growth play? Could you break it down?
Yeah, I think that's a good way to look at it. If you look at TPZ, we've designed that. It's still a good yield, 4% dividend yield, I believe. And but it's got a lot of growth opportunities behind it. And if you look at if you say, well, what are the growth opportunities? Well, it is this electrification. It is basically AI, right? An artificial intelligence and the electricity that's going to be needed really between now and 2030 and really and beyond that. And so if you're a believer in AI and that's going to drive growth in the energy sector, which we are, and you're a believer in the fact that the energy sector is going to be redefined, and natural gas infrastructure is going to play a bigger role. We think that TPC is a good opportunity there. TPYP, little different in that it's broader energy infrastructure. So it's more focused on, obviously, it'll benefit some from the same factors we're talking about, but it's also benefiting from the fact that the U.S. is the largest energy producer in the world. It's also benefiting from the fact that the U.S. is the largest energy exporter in the world, and that those two factors really will drive the sector going forward. So we'll see steady growth in energy production in the U.S., 1 to 2%. That'll benefit TPYP. We'll see steady increase in energy exports going forward, probably 2 to 3 to 4, maybe even as much as 5% here initially. TPYP will benefit from that as well.
Rob, a while back, I used to always hear about energy infrastructure stocks being structured as MLPs. Is that still the case or not so much anymore?
Yeah, there still are MLPs, but when you think about energy infrastructure, the MLPs used to be synonymous with energy infrastructure, as you highlighted. That's really no longer the case. We think that a lot of the best energy infrastructure assets now are owned by corporations. So a lot of the best pipelines are owned by companies that are formed as corporations. There are still MLPs, master limited partnerships, that own energy infrastructure assets, and there's still several really good ones out there. But the vast majority of the really high quality energy infrastructure assets are owned by corporations. I should mention too that the great thing about investing in energy infrastructure is that the U.S. possesses the largest network of energy infrastructure assets in the world. And the other great thing about that is almost all of those energy infrastructure assets are owned by publicly traded companies.
Fantastic. Well, a ton of great information, Rob. I want to thank you for your time.
Thank you.